Yo, 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 what's good? In this show, I'm going to talk a bit about the exciting and adventurous world of debt. The wondrous topic all listeners like to hear. No, I'm joking. But the one main thing that fails to get mentioned by 99% of politicians is the level of debt within the UK. In my opinion, it's the biggest threat facing the UK economy in both the mid and the long term. Debt has the ability to build an efficient and a resilient modern economy, but debt also has the ability to destroy the same economy it built. Since the 1970s, for the past 50 years, there has been a wave, a liberation of credit and lending. But what has caused this liberation in credit and lending? A variety of things. The main thing was the end of the Bretton Woods Act in 1971, where America ended the gold standard, and that was the start of global fiat currency. The creation of the euro. Trillions upon trillions of euros have been created in the past 50 years. This money has entered the economy mainly in the form of credit and debt. The end of Glass-Steagall law in the 90s, that was enacted by Bill Clinton. In 1997, when the Bank of England went independent. These have all contributed towards the complete liberation of credit and the global money supply skyrocketing for the past 50 years. They've also contributed towards a banking crisis in 2008 because the liberation of credit also included subprime lending. And subprime lending in the mortgage market caused the 2008 banking crisis because banks had to book billions in losses when these subprime mortgages got defaulted on. But it's not all been bad. If anything, it's been positive, especially for the boomers and Gen X. Much of this liberated credit since the 70s was the reason why the Western economy grew so strong relative to other economies. The West has grown on the back of credit. The Middle East is currently growing on the back of oil, and China is growing on the back of slave labour. It's the current order of things. Credit has helped build the world's best companies. Tesla, Apple, Barclays, to many other companies. So there is a very positive side to credit. The problem is that during the last 50 years, the level of debt has increased exponentially every single year, with the main rise seen in public debt and unfunded state pension liabilities. As we speak in the UK, our public debt and unfunded state pension liabilities bill, they both tally up to £9.5 trillion. 2.7 trillion public debt, 6.8 trillion unfunded state pension liabilities. This is over 4 times the size of the whole UK economy. The unfunded state pension liabilities have gone crazy, mainly due to inflation pushing up the triple lock. 6 years ago in 2008, this debt stood at 4.8 trillion. It's now 6.8 trillion. To put this into perspective, the total value of all UK properties, I think it's just short of £9 trillion. The total value of all UK land is between 4.5 and £5 trillion. So UK public debt and unfunded state pension liabilities exceed the value of the British property market, and they exceed the value of the British land market. They're also 3 times the size of the FTSE 100. I think within the next 15 years, I'll probably say within the next 5 years, UK public debt and unfunded pension liabilities will break the £10 trillion mark. The way I look at it is Britain's public debt is the fuse, but unfunded state pension liabilities, that's the bomb. On top of this, the UK has a lot of mortgage debt. It's not really problematic though. The mortgage debt is currently standing at £1.7 trillion. It's not really a threat because this mortgage bill has underlying property value totaling just short of £9 trillion. I think it's £8.7 trillion is the total value of all UK property. So the value of the UK property market is roughly 5 times all UK mortgage debt. The UK property market would have to collapse by 85% for the whole property market to be in negative equity in terms of all the mortgage debt within that market. And that's a very, very unlikely event. When you look at it like that, UK mortgage debt doesn't really seem a problem. Then we've got unfunded public sector pension liabilities. They tally up to £2.3 trillion. I'm iffy on this one because I think politicians will prioritise paying public sector workers pensions over holders of UK public debt. I think a lot of people think it'll be the other way round. And the reason being why this is because not paying public sectors will be very, very damaging for the government, and it will most likely create some form of social unrest. And the people who protect the government are public sector workers. Imagine all the police officers and security services being told they won't get their pensions. Imagine civil servants being told the same thing. Imagine firemen and healthcare workers getting told to say bye-bye to their pension. That's causing social unrest, I'm adamant, without a doubt. So due to this being the case, I don't think the government will screw public sector workers' pensions. I believe they will first screw holders of UK public debt, and the main victims will be pension funds. UK credit card debt, that's at £70 billion. UK student loans, £206 billion. And UK car debt, £45 billion. So these three total, £321 billion. UK corporate debt is quite high, but it's not a threat. According to NatWest Bank, UK corporate debt levels are at multi-decade lows in terms of debt as a percentage of nominal GDP. UK corporate debt stands at around £1.5 trillion. UK corporates have assets and capital far exceeding £1.5 trillion. So it's not really a problem. By the way, this doesn't include debt within financial institutions, because the majority of banking debt comes in the form of deposits and very liquid assets. UK private sector pension liabilities for private sector workers, that stands at £2.6 trillion. But this is government numbers going back to 2018. 2.2 trillion of DB and hybrid workplace pension entitlements, and £350 billion of DC workplace pension entitlements. These numbers are most likely higher now because this is 2018 numbers and the government numbers, but I couldn't really find some strong up-to-date numbers on that. But we'll stick with the government numbers, 2018, £2.6 trillion. Now let's tally all this up. Public debt, £2.7 trillion. Unfunded state pension liabilities, £6.8 trillion. Unfunded public sector pension liabilities, £2.3 trillion. Mortgage debt, £1.7 trillion. UK credit card debt, student loans and car debt, £320 billion. Private sector debt, £1.5 trillion. UK private sector pension liabilities, £2.6 trillion. This totals £17.9 trillion. I repeat, the total number is £17.9 trillion with a T. There are other small pockets of debt within the UK economy. Finance goods, council debt, the mum and dad paper market, and a variety of others, but they're not problematic. They're minuscule. So as we can see, the UK economy and the state are holding an immense level of debt, where state pension liabilities and public debt, that accounts for 2/3 of this debt pile. Personally, I believe if the country doesn't wake up to this debt problem and try to solve it in one form or another, then at some point within the next 15 years, we will enter a debt-induced depression. Or we could enter an environment where the government will fund the debt through rapidly increasing the money supply. This will, just like the 70s and 2021 to now, create a wave of inflation that will trigger a very severe cost of living crisis. It will make the current cost of living crisis look like a walk in the park. What you always need to remember is that inflation is good for a government, but very bad for the party running that government. Look at the UK. In the past few years, inflation has pushed up the UK tax receipts, but inflation has been very damaging for the Tory party. Inflation does boost GDP and tax receipts. Now, I'm going to check how much extra taxes inflation has provided the UK with since 2021. Tax receipts have spiked a lot in the past 4 years. So always remember, inflation is good for government, but it's bad for the party in government. The second solution to this debt problem is a wave of defaults. Plainly speaking, don't pay back the debt. So the two solutions to the debt problem, the £17.9 trillion debt problem, are either hundreds of billions of pounds of debt defaults or debasing the debt via creating inflation while ending a triple lock. If they intend to debase the debt through creating inflation, they need to end the triple lock. They do. That is one major thing that they need to do, because a triple lock pushes up unfunded state pension liabilities. If they can debase unfunded state pension liabilities through creating inflation, they'll have to end the triple lock. So, two solutions: defaults or creating inflation that will debase the debt while ending the triple lock. Inflate the debt away or default on it. They're the only two solutions in my opinion. If anyone else does have any better solutions than these two, then the suggestion box is wide open. Send them my way. I know it sounds depressive, but unlike politicians and media folk, I'm not going to blag people or tell them what they want to hear. The numbers are the numbers. On a historical note, debt wasn't the reason for the stock market crash in 1929, which caused the Great Depression. However, debt contributed towards the depression and prolonged it. Why was this the case? Millions of people couldn't afford to buy a home because credit got tightened and banks weren't lending money. That caused a collapse in property prices. Millions of people see their paper wealth vanish. People couldn't borrow money to start a business because banks weren't lending. And that was problematic in terms of economic stimulus and the labour market. That's why unemployment spiked exponentially. People couldn't borrow money to fill the fridges. People couldn't borrow money to pay the bills. People couldn't borrow money to buy a car. We witnessed this between 2009 and 2012, also known as a credit crunch. There was a credit crunch mainly because banks considerably cut lending and money got tightened because the banking system seized up. The difference between post-2019 and the 1930s is that in 2008 and 2009, global governments embarked upon quantitative easing. They increased the money supply and they pushed that money into the economy, which stimulated the economy. In the 1930s, they didn't do that. And as we see between 2009 and 2012, there was a credit crunch. That was just after the government printed hundreds of billions of pounds. Now imagine that same scenario in the future. But the government cannot create a larger amount of new money because demand for pound sterling is rapidly falling. The market's saying, no, we're rejecting the pound. The only options left are defaulting on the debt, or risking 50 to 100% inflation via rapidly increasing the money. That will cause devaluations because the market's saying no to the new money that you're creating. That scenario there, that's a nightmare scenario for all British people. And if they didn't create a load of money in 2008 and 2009, there's a probability that we would have entered a depression akin to the 1930s. But all of this seems to have been forgotten by most politicians in the UK and most mainstream media. Debt levels now are far, far larger than 2009, mainly UK public debt, state pension debt and public sector worker pensions. Politicians are more worried about cultural issues and foreign issues, but if we compare these issues to the debt bubble in the UK, then they seem minimal. Silly drops in the ocean, cotton within a tornado. And I know all the culture warriors will disagree with me on that. I know all the so-called anti-fascists and eco crew will say, no, we need to focus on morals, ethics and saving the planet before finances. But they're all wrong. Without finance, this country will go back to the cave ages very, very quickly. Money is a power and money always wins. When it comes to money, politicians have no power. Markets run the roost and voters need to start understanding that reality. Politicians don't run the roost, markets do. The minute a market rejects a sovereign currency, the politicians are toast. Due to 50 years of political idiocy and debt accumulation, the market could take out any government it wants because government debt is so sensitive. Liz Truss, John Major, Labour 2008, 2009. Do you think people will give two shits about immigrants and trans people and net zero targets if the UK debt bubble bursts? Hell no. And unlike the 1930s, they won't be able to blame the Jews for this crash. That crap won't wash. If this debt bubble does burst, then politicians can forget about all investment projects, increase in public spending, vanity projects and net zero targets. They won't have the money and the market will charge a very high rate to lend politicians money to spend. UK governments have gone on crazy spending sprees in the past 50 years. Both governments, even the Liberal Democrats during the coalition government. But at some point the market will say, no, sorry, enough's enough. We have to take charge. Markets will tell politicians, future politicians, they need to prove that they can pay back money borrowed from the market. They will need to prove to traders that they are going to start embarking upon rational spending, because if they don't, then traders won't lend the UK money and they won't buy any of the new currency we issue. Look at all the dumbasses in government for the past 30 years. Look how they fucked up. If you was a large investment fund, would you lend the government money when the government just keeps spending your money frivolously and erratically? Would you do that? I'm assuming most of you won't. There will come a point, if you hold UK debt, there will come a point where you will pull out and you will seek other countries that will provide you with more trust and confidence. It's exactly what you will do. That's how the market works. Trust and confidence play a big part in the markets. UK governments, going back to the late 90s, they've been losing faith, trust and confidence. The market has been losing faith, trust and confidence in them. We witnessed this when Liz Truss got into power and the markets went volatile after the budget announcement. Just imagine if the Bank of England didn't have the capital reserves to bail out the pensions affected by the announcement and market movement. There would have been a run, not a big one, there would have been a small run on UK markets. The bond market would have temporarily seized up. Pension funds would have lost billions after revaluations. Traders would have offloaded pounds and swapped them for other major currencies. Other traders would have been all over short in the pound. rates on corporate bonds would have spiked. The same with gilts. Bank lending to pension funds would have dried up. And the domino effect would have been far more damaging, to the point where systemic risk comes into play. Luckily, the Bank of England created hundreds of billions of pounds in 2020, so it had a lot of money on its balance sheet. And a chunk of this money bailed out the pensions that entered crisis due to the market movement enacted by the budget announcement. This type of event will come back in the future. However, I don't think it will be triggered by a budget announcement. I believe something else will trigger it. Most likely a black swan event or a stock market sell-off akin to 1929. So there it is, £17.9 trillion. I believe at some point within the next 15 years, UK debt will cause major economic problems. Problems similar to the 30s depression. I hope for the life of me and for all British people that I'm wrong on this. I hope in 15, 20 years time, I can say I was wrong and I put my hands up for it. But sadly, the law of maths is universal and doesn't lie. Politicians lie and talk bollocks about all things. But the numbers are the numbers and they don't lie. And no politician or mainstream media firm can change this fact. In the UK, the numbers do not look good. And our debt bill is the biggest threat facing the UK economy. That's what I personally believe. Hopefully some politicians can realise this and plan to protect the UK economy from the debt bubble bursting within the next 15 years. Because the only two options are debt defaults or inflation. But that's not going to happen, and hoping for it is living in fantasy land. Politicians don't know how to navigate markets, and they haven't done since Thatcher came out of power. John Major Black Wednesday, Tony Blair subprime lending, the banking crisis, Gordon Brown selling off the gold at bottom prices, David Cameron allowing a rapid increase in the UK money supply that created a decade of asset inflation and falling real wages. Theresa May was okay, I guess. She's probably been the best one. Probably because her time in power was quite short. Boris and co, their spending decisions were absolutely crazy. Far worse than Labour during the global financial crisis. Go and have a look at the UK money supply since 2020. And you'll see exactly what I mean. Liz Truss, well, I'll let you decide that one. And Rishi Sunak, it will just make it worse. The coming Labour government will make it worse. It might provide a bit of stability and growth, but the debt level will keep rising under Labour's watch. You'll see exactly what I mean. But the next 4 years will show us if this is the case. I'd bet money on Labour failing and not producing. But pockets of the UK economy and the business sector will flourish. And there's a lot of opportunities out there. A hell of a lot of opportunities out there. I'm quite bullish on many parts of the UK economy. No, sorry, not the UK economy. The UK private sector. But on a macroeconomic scale, under a Labour government, there will be no change. Sounds depressing, I know. But reality does tend to be depressing. And we shall see. And I hope the biggest threat facing the UK in the terms of £17.9 trillion in debt, I hope that we can plan and prepare for that bubble bursting. I hope you've enjoyed the show, and I shall see you on the other side. Within the meantime, have a prosperous and a productive time.